Good afternoon, ladies and gentlemen. Welcome back to the 7th of October weekly market review. We have completed the first week of October. How has the first week of October been for you, Gerald?
Well, it's been busy as usual. Quite a number of developments in the market. Whether is it in the US, we saw new economic data coming out. A lot of investors very excited about the Chinese stock market now. While at the same time, we are seeing escalating tensions in the Middle East. So quite a lot for us to be going through during today's weekly market review.
Indeed, yes. Last week was a bit choppy in the market. We have the Hurricane Helene, we have the strike of the US port workers, and of course, the Iran and Israel situation is causing some concern in oil price right now. So I think I will let you go through some of the key data points that happened last week, Gerald.
Sure. So before we start, the usual disclaimers that today's sharing is for information purposes only and should not be taken to be financial advice. Okay, if you find the weekly market review helpful, do leave us a review on Google. And if you are interested in joining SIAS as a member, you can scan this QR code for more details or go to the website sias.org.sg/membership. As a SIAS member, you'll be able to access various online resources as well as investor education programs. Okay, so this is the performance of the global stock market in the past week. We saw that the S&P 500 ended the week slightly up by 0.2%, with gains across the tech-heavy Nasdaq index as well as the Dow Jones index. Okay, closer to home, we saw the STI also having a bit of a bounce by 0.4%, ending just below the 3,600 levels. Okay, the key economic data that came out last week was really the US jobs data. We noted during last week's weekly market review that this is something that we'll keep a very close lookout for. And the data that came out was that the US added 254,000 jobs in September, which was above the market expectations for 140,000 jobs. If you look at the chart here, this 254,000 jobs is also the highest level since March this year. So overall, it paints a picture that the US labor market remains healthy. Okay, so with this, I think it has helped to ease the concerns about a US recession. And we see that being reflected in the bounce in the stock market as well as the bond yield data, as given that investors are now cutting back expectations of the US Federal Reserve interest rate cuts. Okay, so this is what we see for the current interest rate expectations according to the CME FedWatch tool. If you look at what the expectation for the November meeting is, then currently close to 100% of investors are assigning close to 100% probability that the rate will be cut by 0.25% to 4.5 to 4.75%. Okay, and then if you look at the December data, most are expecting a further 0.25% cut, such that we will end the year with a benchmark rate of 4.25 to 4.5%. Okay, so this is the change in expectations that we see. If we look at what the expectations were prior to the jobs data, then we have a higher probability that we might see a 0.5% interest rate cut in the December meeting. Okay, but with the latest data that's come out, effectively investors are expecting each of the rate cuts in November and December to be 0.25 percentage points each. Okay, and we see that with the bounce in the bond yields as well. This is the US 10-year government bond yield, and we see that it has rebounded to about the 3.86% level from a low when it will touch close to 3.6%. Okay, the other key development would be the escalating tensions in the Middle East. We see that the oil prices have spiked by close to 10% over the past week. And this is mainly due to concerns around how the geopolitical crisis in the Middle East will actually affect oil supplies. Okay, so if I were to look at the top gainers within the STI, we saw Seatrium having a 15% gain in the past week. This is largely driven by the bounce in oil price, which is driving improved sentiment towards the oil and gas related names, including Seatrium. Okay. Next, we also have a number of the Hong Kong China related names such as Hong Kong Land, Jardine Matheson, doing well, together with the bounce that we see in the Chinese stocks. Okay, in terms of top losers, we have some of the REITs, given the bounce in the bond yields that we see, as well as some profit taking in the Singapore banks, including UOB and OCBC. Okay, and if we to look at the REITs, what we see here is that the REITs with China exposure continue to do well. So we've got CapitaLand China Trust with a 2% gain in the past week after having a very strong run in the previous week. Okay, some of the REITs with hospitality assets, including CDL Hospitality Trust, also having a bounce given expectations that we will see more Chinese tourists actually going to various tourist destinations and boosting the demand for the hospitality assets. Okay, in terms of the top losers amongst the REITs, we have got the REITs with the US office assets, including Keppel Pacific Oak US REIT and Manulife US REIT, down by 7% to 9%. Okay, I wanted to talk about two REITs that announced acquisitions in the past week, starting with CapitaLand Ascott Trust. We see that this hospitality-focused REIT actually has seen a rebound in its share price from 94 cents to 98 cents as of Friday. Okay, so what was the acquisition that was announced? This is Life Funan. Okay. In case you're wondering what Life Funan is, I had to go and find the exact term that they use to describe this. It is not hotels. It is actually called experience-led social living. Okay. So this is an asset that is actually at Hill Street, Funan, Singapore, at the heart of Singapore Civic District. Okay. So the agreed property value is about 263 million Singapore dollars. And this transaction is something that is expected to be accretive to CapitaLand Ascott Trust distribution per unit. Okay, so I mentioned earlier that the total acquisition value is about 263 million. Part of it is actually going to be used to pay an existing debt. So the purchase consideration will be 146 million, but because CapitaLand Ascott Trust will help to pay down an existing debt, there is another 113 million. And including other related fees, the total acquisition outlay is expected to be 265 million. Okay, part of this acquisition will be financed by proceeds from a previous divestment that CapitaLand Ascott Trust made, which is the Citadines Mall Sophia, Singapore. Okay, so in terms of how this will affect the distributions of CapitaLand Ascott Trust, this is what they expect the transaction to do to their distribution per unit. So before it is at 6.57 based on the FY 2023 distribution per unit. Following the divestment of the Citadine asset, this was expected to come down to about 6.44, but with the acquisition, it will then go back up to 6.67 per unit. Okay, so it is actually accretive to the distribution per unit, given that the EBITDA yield of the proposed acquisition is fairly decent at 4.7%. Okay, so this is actually higher compared to the yield that they exited the Citadines Mall Sophia, Singapore, which was at 3.2%. Okay, in terms of how that will affect CapitaLand Ascott Trust portfolio, effectively what we see here is that the share of contribution from Singapore will increase from 16% to 19%, and it remains core to CapitaLand Ascott Trust strategy. Okay, so in terms of the key timeline, the transaction was announced last week on the 1st of October, EGM is expected to be held in November 2024, and if it is approved by shareholders, the acquisition is expected to be completed in the fourth quarter of this year. Okay, looking at the valuation of CapitaLand Ascott Trust now, trading at a price-to-book valuation of about 0.85 times, which is in line with the historical average, and dividend yield of about 6.1%, which is also above the historical average. Okay, next, we have another REIT that announced an acquisition last week, Mapletree Industrial Trust, acquiring a multi-story mixed-use facility in Tokyo. And this multi-story mixed-use facility would include a data center, back office, training facilities, and adjacent accommodation wing. Okay. The acquisition is expected to be for a consideration of about 130 million. And this acquisition is expected to be completed in the fourth quarter of this year. Okay, so this asset that is looking to acquire has an occupancy rate of 100%, located within a key data center cluster in Greater Tokyo, and the lease is actually with an established Japanese conglomerate. Okay, in terms of valuation that it is acquiring this asset, it is at a 3% discount to the valuation. Okay, and in terms of how that will shift Mapletree Industrial Trust diversification, it will increase its exposure to Japan, which it is one of the largest data center markets in Asia, increasing the exposure in Japan from 5.1% to 6.4%. Okay, and looking specifically at Asia Pacific data centers, then that will increase its exposure from 8.3% to 9.6%. Okay, following the acquisition, you still have significant exposure to Singapore and North America, which make up about 46 to 47% each, and Japan will make up then 6%. Okay, in terms of Mapletree Industrial Trust valuation, currently at about 1.4 times price to book, which is above the historical average, and giving a dividend yield of about 5.2%, which is below the historical average. Okay, in terms of what to look out for this week, we have an upcoming 6-month T-bill auction on Thursday, 10th of October. We'll also be looking out very closely for the US Consumer Price Index data to give us an indication of whether we continue to see inflation coming down. And we also start the US earnings season with the banks, including JP Morgan, releasing their results on Friday, 11th of October. So with that, I'll hand over to Sunny, who will share with us the technical analysis.
Okay, let me share my screen first. Okay, thanks, Gerald, for that updates on some of the movement in the markets and some of the Singapore counters that we should be looking at. So let me touch on the STI index first for the technical analysis. Then I will touch on HSI followed by the US indices. Okay, so the STI index on this Monday morning, we are up about 0.4%. So it's still a pretty positive sign. It's closer to the opening bell at 9 o'clock. STI was up close to 1%. So now about 1 hour into the first hour trading, we are seeing that some sort of momentum being lost on the STI index. So this is not a surprise because we are very close to the year-to-date high, or I would call this the 6-year high that we are looking at on the STI index at 3,652 points. If you look at the uptrend run that we have seen in the past few months, this has been a very strong uptrend run, and now we are hitting some sort of a support condition according to the RSI indicator. You can see that the RSI indicator, the latest reading at 64 this morning, is about 6 points away from the 70-point overbought mark. It's also close to the 67 point, which is the 14 days RSI moving average. So this 67-point level and the 70-point level is giving a lot of pressure to the upward momentum that we are seeing right now. As you can see, once the RSI hit above the 70-point level somewhere in the September period last month, you will see a bit of a pullback. So now the STI is using the 20 days moving average as a support level now. But I believe once it starts to retest the 3,652 points year to date high, then there will be a lot more pressure. And that coincides with also the upper bound of the Bollinger Band right now at the 3,645 points. So I wouldn't think that now is a good time to go and long the STI index. I'm looking for a further pullback, at least to the 50 days moving average at 3,497 points, or we just round it off to 3,500 points. That is also somewhere that we see in the July high as well. So there's a lot of confluence over here at the 3,500 points for the STI index, which will be a very good position to get in to accumulate on the STI index again. Looking at the MACD indicator, we also have a negative reading, and these negative readings do have a slight sort of a residing downtrend momentum, but nonetheless it's still a negative sort of indication that we are likely going to go down further before we see STI sort of consolidate and have a rebound. So on the STI index, we are a bit toppish, 3,650 points, that's the resistance level. Support level coming in at 3,500 points. So do look out for these two levels when trading into the STI index. Next, I will touch on the Hang Seng Index first. I believe a lot of you are very sort of a concern or very interested in the recent uptrend move on the Chinese markets, and that is also reflected on the HSI Index. So as you can see this morning, the Hang Seng Index, let me reset the chart so that you can get a better view and then I can zoom in further. So this morning on Monday, we can see the HSI into the first 30 minutes of trading is up about 1%. If you observe the candlesticks formation, this is known as a doji candlestick pattern, but we are on a daily chart, so we are very early into the trade, so not a confirmation yet. But if let's say end of the day, we do have a doji formation, that means that our market is undecided right now, and hence the rally that we have seen in the past 3 weeks may not have a good chance of continuing higher. So the Hang Seng now at the 22,920 points level has actually breached, let me zoom out a little bit, has actually breached the high in 2023 as well, and that is around the level of 22,700, which is the highest point that we saw in last year. Okay, so going forward, this could become a resistance and support level, but now that we are testing this 22,700 level, it is still not a convincing signal that we have a breakthrough on this 22,700 level. Hence, if it gets rejected, where would the pullback be? The pullback would likely firstly go back to the April high that we saw last year in 2023 over here, this point, which is around the 20,800 points level. So we could be looking at a 1,000 point pullback from the Hang Seng Index if, let's say, after this week, when the Chinese market opens, further news develop on the stimulus or policy measures that could have a pullback on the Chinese market. The HSI could likely pull back to the previous high level that we saw in April last year at 20,800. That is also where I would, in all honesty, I'm also trying to chase the Chinese markets, but technically I do not like to chase the market in my trading strategy. I will always try to look for oversold condition and then have a confirmation on the indicators to say that, hey, we are going for a rebound before I get in so that I can capture majority of the uptrend. But this uptrend that was sort of a triggered or led by the policy announcement did caught a lot of us by surprise. And same as you, I have not managed to get into the Hang Seng Index yet. So I'm waiting for a pullback to the 20,800 before I get back in. And I would just like to sort of highlight over here, this is not a financial advice. This is my personal opinion. A lot of times it's not the stock or the index that make you the money, is your position sizing, your trade management that makes you the money. So what I will be doing over here is at the 20,800 level, I would sort of fire my first bullet. And if you know the sort of position sizing pyramid, it's like I'm going to put maybe 10% of my capital over here first, 20,800. Then I will stagger it down all the way. Okay, to the next support level, which is I will be taking the high of May this year as the next support level, which now also coincide with the 20 days exponential moving average, with the 20 days moving average catching up very soon. So this level at the 19,700 level, I'll move it to the psychological level of 20,000 will be where I will be placing my trades between the 20,800 first support. So between this 800 points level, 20,000 to 20,800, I would stagger 10%, 20%, 30% so that my base is closer to the 20,000 psychological handle level. And if let's say there's a pullback happen, I will be get into a very comfortable level with a very huge buffer to know that HSI actually has room to push higher. Okay, so these are my opinions, not trading advice, not financial advice. So do your own due diligence as well. This is just an opinion for your reference. Lastly, let's move to the US indices. So on the Dow Jones Index, after the non-farm payroll data last Friday, that was definitely a very sweet closing to a very volatile US trading week last week. So we can see that for the last 5 trading sessions in the US, we have seen that for the early part of last week, we had quite a significant pullback, but Friday data does give us a pushback upwards so that all the US indices ended in the positive territory. The Dow Jones Index also has a new all-time close at 42,352 points, with the all-time high on the 27th of September at 42,628 points. So we are more or less about 290, 300 points away from the all-time high of the Dow Jones Index. So will it likely go higher? So this candlestick formation last Friday is a hammer, sort of a candlestick formation, and a hammer usually indicates that the next few trading sessions we are likely to push higher. And the next resistance level that you can look at will be the upper bound of the Bollinger Band over here at the 42,823 points, and that's where I believe the Dow Jones Index will go before it hits some major resistance kind of level where sellers will start to pile in again. Why? Because the RSI index at 63.8 is also about 6 points away from the 70-point overbought level. Hence, if it touched at the 42,800 level, definitely the RSI will go into the overbought level, and then the pressure of a technical pullback will likely start to happen, and then we can have a pullback towards the previous low, which is on 30th of August, around the level of 41,577 points. That is where we could be start to accumulate again on the Dow Jones Index. Okay, so this level also now is quite close to the 41,700 20 days moving average, with the 50 days moving average at 41,141 points. The MACD indicator is showing a little bit sign of a negative sort of a momentum happening. Last Thursday, we saw the first negative reading on the MACD indicator, but we managed to sort of negate that on the Friday session because of the good non-farm payroll data. So I would say the MACD telling me a very neutral kind of reading, which the RSI is more important, where we have to keep a close eye to see whether the Dow Jones Index go into the overbought level, and hence be prepared for a technical pullback on the Dow Jones Index. Okay. Next, let me move to the broader S&P 500 index. Same thing, we got that hammer formation last Friday, and we are about 16 points away from the all-time high at 5767 on last Friday closing of 5751. So the next resistance level I'm looking at will be the upper bound of the Bollinger Band, 5,832 points, which is also my personal sort of a target for this year on the S&P 500 index, which is the 5,800 points on the S&P 500 index. Okay, so indicator wise, RSI at 62 is getting closer and closer to the 70-point overbought level, but still quite safe in that point because it has sort of crossed above the RSI 14 days moving average. That means that it's no longer become a resistance level, and likely we are going to push towards the 70-point RSI overbought level soon. Okay, so that means the testing of the 5,800 level is a very high sort of possibility happening. But if a pullback happens, then definitely the 20 days moving average now at 5,666 points, which also coincide with the July high. That could be the support level that we are looking at if a pullback happens on the S&P 500 index. MACD wise, a slight negative reading, but similar to the Dow Jones Index, we have narrowed that negative reading last Friday. So it's sort of a neutral kind of an indication to me. So I think we still have some legs to go on the S&P 500 towards the 5,800, and likely we are going to see a new all-time high on the S&P 500 going into the earnings seasons this month on with the US financials. Okay, lastly, let's look at the Nasdaq Composite Index. So unlike the candle formation of the Dow Jones and the S&P 500, where we have a very clear hammer, this Nasdaq Composite Index don't really have a very clear hammer signal, but it's still a positive sort of a candlestick formation, I would say, for the Nasdaq Composite Index. So likely, I'm holding my breath also that the Nasdaq Composite Index can retest the all-time high again at 18,671 points, which is what we saw in the July period. But I'm not so confident of whether we can break through this level and go up higher compared to the S&P 500, as we all know that the tech sector or the tech heavy index is quite overvalued, and the rally that we are seeing right now is spreading out to the rest of the other sector. So I think that we could have a good chance of testing the 18,671 point all-time high, but likely this resistance level would likely hold for this year before we reassess what happened next year again. Okay, support level 20 days moving average at 17,791 points, with the 50 days moving average close by at 17,633 points. So 17,700, 17,600, this is the support level for the Nasdaq Composite Index. If you're looking to accumulate Nasdaq going forward, that will give you a bit of a safety buffer towards the year-to-date high. So MACD indicator, quite neutral to me. We got a slightly positive MACD reading on the Nasdaq Composite Index, but that is also a sort of the line on the MACD indicator does not give me a sense of trajectory, and looks to me that it's likely going to traject to a sideways direction. So that I would take it that the MACD is giving us a neutral signal. On the RSI, we have a 59 point reading, okay, on the RSI. So this is slightly 1 point above the 14 days RSI moving average. That means that we still have quite a bit of room to move up to the 70 point overbought level compared to the other two major US indices. So I am actually more confident of the Nasdaq Composite Index having more strength in this coming week to push higher. That means having a better higher gains compared to the other US indices. That also reflected in last Friday 1.22% gain compared to the other two US index. Okay, so these are the updates that I have for you this week. I'm looking forward to the US earnings seasons. Anything else to watch, Gerald?
Yes, I think a very useful update that you gave us on the Hang Seng Index technical analysis. I think that's what a lot of investors are looking out for. And like you mentioned, we are going to the US earnings season, so quite a number of bank stocks earnings that we'll be looking out for this week to understand further the health of the US economy.
Yeah. Okay, so I think that is the time that we have for this weekly market review session. A lot of things will be happening next week. We'll update you on the CPI and the US JP Morgan results. So do stay tuned to next Monday weekly market review. And in the meantime, stay safe and trade safe, and we'll see you next week. Goodbye.